In the world of finance, it's rare to see a total split in opinion. But right now, in the silver market, we're witnessing something pretty wild. Two of Wall Street's heavyweights are looking at the exact same data and coming to conclusions that are, frankly, worlds apart. This isn't just a small disagreement on price, it's a fundamental clash over what our economic future looks like. So, let's dive in and unpack this.
And here it is, laid bare. On one side, you have Bank of America calling for an explosive bull market, targeting $309 an ounce by 2026. And on the other side, JPMorgan, issuing a stark warning of a collapse all the way back down to $50 in that same time frame. The difference between those two forecasts is a massive $259 per ounce. You almost never see a divergence this wide between two major banks. For anyone in this market, it's a huge problem. One of these forecasts means a once-in-a-generation opportunity. The other suggests a complete disaster for your capital.
So, it really makes you wonder, right? How can two teams of top analysts with access to all the same information arrive at such completely opposite ends of the spectrum? Well, the answer isn't really in the data itself. It's all about the fundamental economic worldview they use to interpret that data.
All right, here's how we're going to tackle this. First, we'll look at this tale of two forecasts. Then, we'll break down Bank of America's bull case, which is all about something called ratio compression. After that, we'll flip it and dig into JPMorgan's bear case, the idea of a speculative unwinding. Then, we'll weigh the evidence, and we'll finish up by outlining the three key risks you need to be watching.
So let's be really clear here. This is so much more than a simple disagreement on price. This is a clash of worldviews. Bank of America's $309 world is one where inflation runs hot and currencies lose value, pushing people into hard assets like silver. JPMorgan's $50 world, that's a future with a deep recession, where speculative bubbles pop and the US dollar is king.
Okay, first up, let's deconstruct Bank of America's bullish thesis. Their entire forecast, from their conservative guess to their most extreme number, really hinges on one single powerful idea.
And that idea is the gold-to-silver ratio. It's simple, really. It just tells you how many ounces of silver it takes to buy 1 ounce of gold. The entire foundation of Bank of America's argument is that this ratio is set for a massive, historic squeeze, meaning silver is about to start dramatically outperforming gold.
So, why do they think this ratio is going to shrink? They've identified a few key drivers. First, the silver market is just way smaller than gold, so the same amount of money coming in has a much bigger price impact. Second, it has two sources of demand, investment and industrial use. History also shows that silver tends to lag gold at first, but then really takes off in the later stages of a bull market. And finally, in an environment where currencies are being devalued, you get retail investors piling into the cheaper precious metal, creating that classic FOMO, the fear of missing out.
Okay. This is where it gets really interesting. Let's look at the math for their more conservative target. They start with an assumption of $5,000 gold. Then, they assume the gold-to-silver ratio squeezes back to 32-to-1, which is the level it hit back at the 2011 peak. You just divide $5,000 by 32, and you get a silver price of $156. Their official target is a bit more conservative at $135, but you see the logic.
And this is how they get to that headline-grabbing number. They model a more extreme scenario. What if the ratio compresses all the way to its historic low of 14-to-1, which happened back in 1980? Well, you take that same $5,000 gold price, divide by 14, and you get a silver price of $357. They round that down to get their high-end forecast of $309.
Okay, let's switch gears completely. Now for the other side of the coin, JPMorgan's warning. They pretty much ignore the whole relative value argument and instead focus on technical signals and the market's internal health.
At its heart, JPMorgan's argument is that the recent spike up to $122 wasn't real. They see it as a speculative bubble, totally disconnected from actual physical supply and demand. And in their view, moves like that are unstable and are always followed by a very painful and long correction.
So where does their $50 target come from? It's a technical tool called Fibonacci retracement. The basic idea is that after a big, speculative run-up, an asset tends to give back a predictable chunk of the gains. In this case, JPM is looking for a deep retracement, 78.6% of the entire move from the $29 bottom to the $122 peak. And as you can see from the math, that erases about $73 off the high, which lands you right at their target of around $51.
And this isn't just a technical guess. It's backed up by their big-picture economic view. This chart shows it perfectly. There's a strong inverse relationship between silver and the US dollar index. When the dollar got strong in 2015 and again in 2022, silver took a nosedive. Since JPMorgan's outlook includes a stronger dollar, this is a major piece of their bearish puzzle.
So there you have it. Two perfectly logical but completely opposite stories. The big question now is, what does the actual data say? Let's step back and see which of these arguments holds more water right now.
And when you look at the evidence, you can see exactly why they're so divided. The data is sending mixed signals all over the place. The bulls will point to the fact that we're in the 6th straight year of a supply deficit and that gold is holding strong. But the bears will point to weakening industrial demand and the nasty price rejection from that $1,220 high. Even ETF holdings are confusing. The total amount of money invested is still high, which is bullish, but the flows of money actually turned negative at the price peak, which is a classic bearish signal. By the way, if you're finding this kind of structured analysis valuable, it would be a huge help if you'd like, share, and subscribe. That way you won't miss our future work as we keep tracking these markets.
So, with all of this conflicting evidence, it's pretty clear that neither of these extreme outcomes is a sure thing. Based on everything we've looked at, this whole conflict really boils down to three main risks that every investor needs to have on their radar right now.
First up is ratio reversion risk. Bank of America's whole case depends on that gold-to-silver ratio shrinking toward historic lows. It's a compelling argument, but it's absolutely not a guarantee. Second, there's macroeconomic risk. A really bad recession could crush industrial demand for silver, or if central banks suddenly turn aggressive on interest rates, that would completely support JPMorgan's bearish view. And finally, there's consolidation risk. The chance that neither side is right and the market just chops sideways for years, frustrating everyone.
And all of this brings us to the final critical question. In a market being pulled in two opposite directions by such powerful forces, where there are solid arguments for two completely different outcomes, the challenge isn't just about picking a side anymore. The real question is, how do you position yourself to capture a potentially historic opportunity while also making absolutely sure you preserve your capital? That is the core dilemma facing every silver investor today.